Thanks to Jerome Powell, markets are in free fall. Just what I wanted for Christmas. So be prepared for the market crash headlines that you'll probably start reading. In reality, we had a day that wasn't even down 3%, but volatility absolutely exploded. And according to the VIX, the last time we saw these reads was back when the yen carry trade panic gripped the market in early August. And surprise, surprise, how poetic, the Bank of Japan actually has a meeting tonight. So before we get to the technicals, I do want to start tonight's episode by telling you the story of why this is all taking place. So everybody knew that at 2 o'clock, Jerome Powell was going to cut interest rates by 25 basis points. So why then did the 10-year interest rate rally aggressively in the upward direction at the same exact time? Well, the answer is because not everybody knew that Jerome Powell was going to break a promise that he had made the market back in September. In this summary of economic projections, the SEP, if we scroll down to the median projections for 2025, this is back in September, what we want to focus on are these two numbers down here. Notice that the June projection was at a 4.1, and in September, Jerome Powell said, we're feeling pretty good. We're going to revise that number down to a 3.4. This is the Fed funds rate that we were expecting through 2025. And at this current point in time, what this would have suggested was 4 more rate cuts from the Fed in 2025. You'll also notice here that the Fed was getting pretty confident on inflation. We saw a revision from 2.3 on the core PCE to a 2.2, closer to the Fed's target of 2% flat. So that was looking pretty good. That's a pretty bold promise to make from Jerome Powell back in September. Well, lo and behold, today we got a new update to the summary of economic projections. This is the December 18th release. That's today, of course. And if we scroll down, Jerome Powell and friends absolutely pulled the rug out from underneath the market. What you'll notice is that the median projection now for the Fed funds rate in 2025 has been revised from a 3.4 to a 3.9. Suddenly, instead of expecting 4 rate cuts in 2025, the market should only be pricing in 2 if we're lucky, according to Jerome Powell himself. If we take a look at the PCE revisions, I thought we were getting confident on inflation. I thought that was the whole reason that we were cutting interest rates here in the first place. Jerome Powell. If Jerome Powell was going to be prepared for his press conference, he should have had these statistics. He should have said, hey, if you take out owner's equivalent rent, if you take out motor vehicle insurance, we're actually in a better spot relative to December of 2019. However, Jerome Powell stumbled over his words, and instead, he focused on the labor market. And he also brought up that we do not welcome, the Fed does not welcome, any further cooling in the labor market. So why then focus on the idea or the statistic, it's just a fact, that the current hiring rate is underneath 2019, and we're continuing to see deterioration over here? Why focus on that if you're not welcoming any further cooling in the labor market? And if we just go back to the updated SEP and take a look at the balance of risks, let's scroll down here. First of all, let's stop off on the dot plot. Notice that a majority of participants are now in the camp of a 3.9 versus if we go back to September, let me just zoom out and scroll down. We'll go down to the dot plot. Notice the distribution of participants down here. Far more participants were thinking, okay, we can probably get closer to a 3%. Not anymore. The updated December SEP has a majority of participants at 3.9. What's going on here? The Fed is all over the place on the dot plot. If we continue to scroll down, though, what I want to focus on next is the balance of risks. Let's scroll way on down. Thanks for bearing with me. What we want to focus on first is the risks to the unemployment rate. Okay, this makes sense. Instead of the risks being weighted to the upside, which we knew was the case prior, that's the dotted line, you're saying that things aren't so bad. We're seeing the balancing of risks. Okay. Well, why then focus on the hiring rate like you just did? Should that not be weighted to the upside? Why are you revising this to more broadly balanced? That doesn't really make sense. That's a contradiction. If we scroll down, let's take a look at PCE on the core side. I'll even zoom in on this a little bit. Now inflation is weighted as a risk to the upside from broadly balanced? I thought the whole reason that we were cutting interest rates today, the reason we had the ability to cut interest rates, is because we were making progress on inflation and we could look through the stickier than expected owner's equivalent rent as well as motor vehicle insurance. So a very, very contradictory report from the Fed during today's session which did not signal whatsoever to the market any semblance of confidence. Now, if we pair this, let's go all the way back up to the projections again. If we pair all of this conflicting data, which is really a lack of confidence, as well as, we all know that the market loves rate cuts, right? Send those valuations through the roof. If we're not going to get lower rates, or as low as the market was expecting, and we pair that with the idea we've been talking about for the last week and a half or so, that market breadth is absolutely atrocious, then was it reasonable that the market could have broken down during today's session? Did it make sense that we acknowledged these risks in the Saturday update video? I think the answer is absolutely. So now that we know why the market's broken down, based on the premise that Jerome Powell yanked the rug out from underneath us, no more rate cuts for the market, right? Or at least not as aggressive as it was expecting. Let's go ahead and take a look through the technicals. Now that we know what's going on, let's take a look at the SPY daily time frame chart. What do we see here from a trend perspective? Well, recall from the Saturday update video, I had been talking about this being the first hourly downtrend that we had seen since this pullback back here, which means that from here to here, we had a daily higher low. And that's a pretty big daily higher low. In the weekend video, I was saying that I was willing to give this some wiggle room down to $600.50. As of today's close, you can see that that did not act as support. This did not act as support. The daily 50 SMA did not act as support. So is the daily trend up? The answer has to be no. Is the daily trend down? It's certainly suggesting that a downtrend is likely here. Lower high can be set anywhere underneath $600.50. Would I want to be a brand new money short here, dead on the lows of today's session? The answer is no. I think that's poor risk management. I think that because the remainder of the election gap remains underneath us, this is something that we should focus on if you are looking for a short and the market does not set a lower high first. If we're in the election gap, there's a way to manage your risk. If the market's just sideways down here, it becomes really, really tough to justify risk-reward-wise getting short ahead of the breakdown. It would actually make more sense that a counter trend move would suggest long-sided risk-reward. Now, do we want to overstay our welcome on the long side? The answer to that is no. As we just said, a daily lower high can be set underneath previous resistance. Previous resistance did not act as support. It can act as resistance again. And if we see that move, let's just put that in like this, what does this start to suggest? Left, head, right. Then suddenly a neckline breakdown really gets you that election gap close. That's under 583.85, closes to 576.75. Beyond that, the next key level is at 569.85. Now, this of course is going to take some time to play out. So how do we ultimately get there? Well, a counter trend move you want to take at face value. If we start to see a rally that rejects underneath 590.25, maybe you have some sort of risk reward that gives you this setup to the downside. That's a possibility, but I would not overstay my welcome at the bottom end of this move. Let's say we go a little bit further than that. There's an hourly Brigade bolt up and over 590.25 to trade into 595.25. You could trade from A to B, and then you can trade from B to A, not B to C, all the way down here. Why would I not take this trade short here with a target down at the lows? Why would I not take this trade? Let's start thinking about things other than just the daily time frame chart. Hopefully, you're starting to think about the weekly time frame chart. If I clean up the drawing set and zoom in, the weekly chart has not changed trend. It is pulling back from the highest high in the trend count, and as we discussed on Saturday, this level right here at 585 is absolutely an opportunity for the weekly time frame chart to produce a higher low. This red bar did not contain a daily downtrend, so therefore, it's a weekly soft higher low. And if we make a firm higher low at the equivalent level and rally away from it, this is a great spot for trend continuation. Lows, higher lows, higher lows, higher lows happening here. And if that's the case, that's the exact reason as to why I would not want to overstay my welcome on a potential short off of this level beyond a retest of the next level down below. Reason being is if the daily chart starts to do something like this, let's say, and then support here, what did I just draw? Weekly is finding a higher low, daily is trying to find a higher low double bottom over the neckline, and I would really start to think more constructively about moves in the upward direction. So that's kind of my concern about the competition of the timeframes right now. I don't want to be just, dense and say things like, hey, it's got to be back higher, the trend's got to be up on the weekly. No, this is a severe change in tone, and we're certainly acknowledging that here in today's episode. It's not only fundamentally a shift in what the market expects, but trend-wise, it's a huge violation of this key level that we've been talking about to break and close underneath the daily 50 SMA. Let's not be dense here, right? The trend can easily flip to the downside, but into the end of this week, really into the end of 2024, because remember, we have 2 shortened holiday weeks upcoming, the Christmas week and the New Year week. That means that you're going to have lower liquidity, which means higher volatility. Do you want to try to be a hero in the holiday trading season? Personally, I don't. I want to enjoy my holidays, right? So I'm going to treat every single level here at face value. If we start to get this, there's the possibility of some scalps from A to B. If we move from B back to A, great. There's a possibility of a scalp to the downside as well. If we get a Brigade bolt lower high underneath, great. You could move from A to C. Let's label that as C, right? And we start to build out the head and shoulders. I think the cleanest risk reward, as we've already mentioned, involves the gap down here, just because it's so clear as to what's going on. You're making a lower low underneath this pivot after setting a lower high. The daily trend is clearly down at that point, right? So until the daily lower high is set, I would be a little bit cautious of that weekly higher low. So we're all set here. One final caveat is if for some crazy reason the weekly bar closes back over $600.50, I would have to imagine that this market is a long into the early stages of the new year. If we just got that fundamental shift, if we just got this big liquidation to the downside, and yet the weekly bar closes over $600.50, again, I'm not going to say that that's a high probability outcome. The odds of that are extremely slim. But if it does take place, you know what to do. Anything over $600.50 again, it's got to be going for new record highs here in the S&P 500. So we'll end on that optimistic, yet probably pretty low probability outcome into the S&P 500. Let's take a look at the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. The main premise here is that we had very substantial volume outflows. The actual reads of the breadth ratios horrific through the day's session. Look at the S&P 500 read, negative 25.76. Horrible ratio of volume flowing into down stocks relative to up stocks. The advanced decline line dropped from positive right at the zero line to well underneath trend lower zone. The index score, hammering negative 30 into the close. It closed at negative 29, but you better believe it was at negative 30 for a majority of the actual push. Look at the ticks down here. Huge reads underneath negative 1,000. So not only was it a fundamental shift, as we've described in the intro, but the technical picture is really reflecting some heavy-hitting selling hitting this marketplace on today's session, which, again, not to say that this is a bold claim. Of course, you could see that if you're just looking at the price action, right? So that is your S&P 500. Let's take a quick glance over at the NASDAQ. A little bit different over here. We're pulling back from the highest high, not a balance range. This also has a cleaner opportunity for what I would consider a daily higher low still to preserve the daily uptrend in the NASDAQ. A higher low happening here at 514.85. We closed the gap from here. If we can support this, I really don't see a reason to believe that the NASDAQ in particular is moving more aggressively into a downtrend. The only thing that would change my tone here is if a lower high is set and then we breach this. So I would not be bearish the lower high. I would be bearish on the break of the equal low, which would be in violation of previous resistance. That's if we get a counter trend move, starting to act as support, offering a daily higher low. It makes sense based on the trend count, right? If this holds up, this is not bearish. This is bearish into the equal low. Now, of course, if we continue to the downside here, undoubtedly the previous all-time high has to be the level to monitor at 503.25. Just zooming out so you can see this big previous pivot high, a little bit scattered through it on the election move, right? But if we drop underneath 514.85, that to me has to be the big retest. A glaring difference here as well between the S&P and the NASDAQ is that you're still over your daily 50 SMA. You have not breached with a daily close underneath on the NASDAQ side of things. So, is it reasonable that the S&P holds a weekly higher low if the NASDAQ holds a daily uptrend? Absolutely. I would definitely pair those two things as a reasonable outcome in your mental sort of log of possibilities for what the market can do, right? So anyways, 514.85 is your do or die. Obviously, the gap has closed. We can start to get rid of some of these yellow lines in here. Let's just clean that up a little bit. If we hold 514.85, counter trends can get into 521.75. Anything beyond that is 526.50. Just like the S&P 500, treat each of these at face value. I would probably be more bullish in the NASDAQ versus the S&P for all of the reasons we've just described. Daily higher low is much more ideal here. I would be more open-minded to a stronger move in the upward direction. I would only change my tone if we're back down here at an equal low after setting the lower high, right? So not bearish here, once again, bearish down here. And we already know what the downside targets are. If this extends the loss into the end of the week, I would start thinking about a counter trend move off of 503.25. And we'll update you with further levels if need be in the Saturday update video coming shortly. Obviously, we don't have too many days before the end of the week. So that's your NASDAQ. No need for hourly charts here today. Let's take a look at the NASDAQ internals. It's going to be a rinse and repeat of what we have over here. Substantial volume outflows underneath trend lower zone, huge negative ticks out of the tick queue. It's a rinse and repeat, an absolute bloodbath from a fundamental and technical perspective at the exchange level. But once again, the NASDAQ itself is in a better position to potentially hold for a daily higher low. Small caps, what do we see out of smalls? Abysmal. It's been in a downtrend prior to, and remember that markets do not crash from the highs. I think now is probably a good time to bring that up. Markets don't crash from the highs. Markets crash from the lows. So right when you think everything's about as bad as it can get, that's when a market crash actually takes place. Go back and study 2008, go back and study, the dot-com bubble, study all these things. The market had already been in a weekly downtrend for quite some time. In this case, the reason I bring it up is just because the IWM had been in a daily downtrend for some time. So the fact that small caps are not holding up over this weekly line in the sand, let's go to a weekly chart here on the smalls, because this is a great illustration. The fact that you're already so severely underneath this leads me to believe that the small caps will act as a headwind for the S&P 500. There's a clear opportunity, if we just drop it back down to the daily now, very clear opportunity that any counter trend moves are, that could be a substantial counter trend move. We're talking about 220 to like 227. That's a pretty solid move, right? Especially considering this has been a grind recently. If you get that, a lower high that's set here fails the breakout, and I would start to become more bearish in the broad market in general. Right? So this is absolutely a risk for the S&P 500 more so than the NASDAQ. And I think that this just reinforces all of the concepts we've been talking about for the past couple of weeks, right? If you want longs, go in the NASDAQ. If you want shorts, focus your attention on the S&P 500. So IWM all set on this. Let's take a brief glance over at the Russell internals. Nobody should be shocked. Huge volume outflows, big negative ticks, and closing underneath trend lower zone out of the advanced decline line there. Any other comments here? Not really. Just remember that 227 is your key inflection point out of the small caps. If you rally into it, really expecting a lower high reversal there, keeping the bearish pressure on. If there's a miraculous recovery effort, hey, maybe we change our tone, but I really don't see that as being a high probability, noting the fundamental shift that took place based on the updated SCP. In here, be my guest if you want to be a hero. Just generally speaking, I'm using this as a headwind for the S&P 500. Let's take a look at the sectors. Obviously a bloodbath in terms of the weekly performance. Excuse me. But let's take a look at the actual structure. Energy getting absolutely crushed. Fears of a global recession, this is still making sense. U.S. recession, probably not. We know that the Atlanta Fed GDP nowcast is sitting at like a 3.3. We've been talking about this, which once again, if you want to tie this back to the fundamentals, kind of gives Jerome Powell leeway to keep rates restrictive from a growth perspective and say, hey, we're going to avoid a recession, right? He was pretty firm on that stance too as well, which is just so funny. Is like, of course, he's going to affirm that we've avoided a recession, but hey, we've got to be careful about the labor situation. We don't welcome further cooling there. Maybe we will fall into a recession, right? Kind of careful dancing around the wordings there. But anyways, global recession out of the XLE, not in the US. Generally, this might put some downward pressure on inflation, believe it or not, from the energy sector. Let's move along, especially headed into the winter. That's something to consider. Here's real estate, obviously responding to interest rates ripping to the upside on the revised SEP. So huge new swing low is a big deal. But so far, energy and real estate are lightweight sectors, as is the XLB. Materials is the lightest weight sector in the S&P, making a new swing low. So these things are bearish, but this is where the important stuff starts to come into view. Financials have been burdened here and absolutely are breaking into the election/JP Morgan earnings gap. And as of right now, not really getting a move that would be suggestive of financials helping turn the S&P 500 back around. I think with the higher for longer, it's putting a damper on some of the euphoria that was there with the whole deregulation thing, right? We were thinking, okay, interest rates are going to get cut big time. Deregulation's right around the corner. It's got to be a great environment for getting deals done. Well, with interest rates no longer forecast to move in that direction as aggressively, I don't know. It takes one of the components out of the equation here, and it certainly makes sense as to why financials were down so aggressively. So seeing this to the downside, slamming through the 50 SMA, maybe there's some sort of response off of the previous all-time high, but we're in gap territory. Easy opportunity for a lower high. Continuation here. That's where your oversold rally comes from. But generally speaking, a bit more concerned. Would have been best if financials had the opportunity to produce, look below and fail. That would have been the most bullish rotation for markets. Obviously, we're not getting that. If we look at communications, the story starts to get a little bit better. Obviously, we're in a ripper of an uptrend here, and we have previous resistance that can act as support. Great opportunity to set a daily higher low. Remember that this breakdown over here did not really count as a daily higher low. It was simply a liquidation break. But this can set a daily higher low over previous resistance. Communications are more of a risk-on sector. I would love it if 97.65 can hold up. We're over the daily 50 SMA as well. Okay, not so bad. A pullback from the highest high, the all-time high. Let's take a look at industrials. A little bit more meaningful, underneath the neckline of the double top, but still well above this compression, which led to the breakout. Weekly higher lows on the table. Daily is absolutely in a downtrend. Let's not try to hide this one. Plenty of opportunity for bearish action here, bearish action happening here. So we're not out of the woods. This certainly could set up a Man Ray pattern. Not liking what I'm seeing out of industrials, but still not one of the heaviest weight components. Let's move along to utilities. Not looking great. We know that this is bond-like, so without the cuts from Jerome Powell, seeing this move to the downside makes sense. Let's take a look at XLY. This is where we get right back on the bull horse. Yes, we have a bearish engulfer. Yes, there's a change in tone, but is the daily trend obliterated? The answer is no. This has actually overtaken, right, some of the other heavyweight components. This is now number 3 in the lineup of heavyweight components from the S&P, overshadowing what was the healthcare sector, right? Healthcare is really taking a back seat here. Financials and discretionary moving in the upward direction. So seeing this, I would love an opportunity for a hold over 220.50. Show me weekly consolidation. This thing has been off the chain. I mean, not to use a term that's forgotten long ago, but man, look at this move. You're telling me that we can't afford some weekly consolidation up here? Of course we can. So not really all that bearish on discretionary. I think absolutely, again, change in tone, yes. But am I calling for markets to fall into weekly downtrends? Oh my goodness, we're going to go to zero? I'm not seeing it yet. Semiconductors definitely have some more explaining to do. The balance range is at risk. Bearish engulfer, back down at the daily 200. I really think that this is susceptible underneath 237. Reason being is that MU earnings did not go well in the after hours. Let's quickly click up that chart here. MU is trading in the after hours at 86.90 by 87. Down here, right? Down here. Here's today's close. So big gap down out of MU. Obviously, SMH is not quite reacting the same. You can see in the after hours, we're almost unchanged, down slightly, 241.27 by 56. Here's today's close. But the premise here is just that this thing can't get in gear. We're back down yet again at the bottom end of the balance range, and I would think that anything that does this is a headwind for the broad market as a whole. So structurally, we're doing okay in some of the heavyweight sectors. But the semiconductors pose the largest threat, in my opinion. Here's the technology sector failing the previous all-time high. Does not quite look as good as the QQQ. So noting the close under the daily 50, back inside of this balance over here. Not liking what I'm seeing. A little bit of a double top and underneath the breakout point. So given that, I would say it needs to hold or promptly get back above. I would say if we're over 234, we're back in business. We're doing okay. If we're underneath, okay, probably thinking about daily 200 SMA. Another headwind for this would be coming from semiconductors, as we just saw. Healthcare, falling off of a cliff. New pivot low. Heavier weight component of the S&P 500, right? Not the heaviest, but it's still heavy. This is in a weekly downtrend at this point. It is underneath the neckline of what could be considered left head, right shoulder over here. Not looking good. Lower high opportunities everywhere. And this is, of course, going to act as a headwind for the S&P 500. Not loving it. Let's look at consumer staples. No new pivot low, so that's interesting to me. Sort of in this balance range happening here. If it does make a new pivot low, that's where I would be a little bit more concerned. So generally speaking, the consensus is that we have some concerning things happening, like financials, right, in this gap, looking like it can possibly extend. And if this doesn't catch support, that's not going to be helpful for the S&P. But then you've got things like discretionary, clear opportunities for higher lows, and then you're sort of mixed in between here in something like XLK. It's not the end of the world. You're still grinding in the upward direction, but today's change in tone could easily develop into more. So the market's precariously propped here, and I would watch these sectors carefully into the end of the week to see where they really settle out. If we just rip through some of these additional charts here, let's see what we've got. Sector ratio, still doing okay here. This is still looking great. This is a non-issue. This is starting to become an issue. So let me put a little squiggly mark here, noting that we're now underneath the 50 SMA, the gold moving average on all of these charts. This is perking up, but not in a big way. This is trying to flatten out, but not in a big way. So it wouldn't seem as though we have a big risk-off rotation. It's not like people are selling off tech to buy the risk-off sectors. It's selling across the board, and even amidst some of the selling, you're not seeing a risk-off rotation or like safe haven assets catching a bid. Let's move into risk-on versus off. So generally speaking, this can catch for a higher low, this can catch for a higher low happening here, higher low happening here. I really think, once again, based on the S&P analysis, we want to be open-minded to that weekly higher low. Nothing is really devastated through some of these looks. Again, Santa Claus rally probably isn't coming to town based on our thesis from what was going on in the weekend update video, and our breakdown is coming to us here. But not to the degree of like a weekly downtrend yet. And we've been pretty adamant about that weekly chart being the main guiding factor to whether or not we're ready to throw in the towel on the long thesis. Dollar ripping to the upside, not a shock given what's happening here with the Fed. Let's take a look at interest rates, which I showed you in the very beginning. Moving to the upside, 4.5 is a breakout point in the 10-year rate. If it does move higher into 4.7, I think we have further downside to go in the market itself. If this simmers off and backs off, I think that's where you get your counter trend move. So interest rates will be a top watch into the end of the week. TLT ratio to the S&P starting to curl higher here, but still underneath. Let's bring this level down, actually. We'll start to call for a flight to safety if we're over the 0.16 mark, and this outperformed by technically moving lower less. All right, so keep that in mind. They're both moving to the downside, but this moved lower less. Just for full transparency's sake, once again, I'll remind you, I do have a short put position at 85. Whenever I mention that I have a position, I feel obligated to keep you posted. I closed out some expiries for the 20th. That's on this Friday, of course. Those closed at 0, basically, and 85 puts going out to February at this point. They're slightly taking some heat, but pretty confident in that position. There's plenty of time. And even if I do get assigned, feeling okay about an 85 basis on the TLT, we'll farm the yield for a little bit out of that. Anyways, that's your update on the position there in case you've been keeping track. Bonds relative to themselves, not a shock happening here, right? The Fed mentioning, hey, inflation's maybe not under control. Reason why it's higher for longer, not expecting as many rate cuts in 2025. Not a shock to see the move higher out of bonds relative to themselves. If we move over to credit spreads exploding to the upside here, this has everything to do with volatility, right? Everything to do with volatility and future expectations, really on the corporate grade side versus government backed. So if you take a look at HYG in isolation, it fell off of a cliff today, right? Any shock over here? No, absolutely not. Not a shock at all. If you take a look at this, right, there's actually a bearish divergence from this previous pivot low, which is the equivalent of this pivot low. The S&P still isn't even underneath that level. Notice that there's this opportunity here, right? So junk bonds getting absolutely crushed on the premise of the fundamental shift that we've been talking about in today's episode. If we look at Bitcoin, we know that this pulled back slightly. There's a ton of people. We were live during the FOMC. What's going on with all the spammers saying that like Bitcoin was crashing? Be real. I mean, come on. This is still breaking out. Pull back. This would be a pullback. This would be a buyable pullback, in my opinion, to set a higher low and continue higher. Jerome Powell, of course, mentioned that it would be illegal for, at least currently, under the current U.S. law, for the government to have a strategic Bitcoin reserve. So we'll see if that changes. Maybe that was the fuel to the downside. But, you know, all this talk about like, oh my God, Bitcoin's crashing. I don't get it. It's hanging out near the highs. It's still over $100,000 on the futures here. Anyways, maybe I'm just, maybe I don't get it. Matt, you don't get it, dude. You're not in tune with the crypto market. Okay, whatever. Here's the breadth readings. These were the threats we had talked about on Saturday. Obviously, they came to fruition. And this is just generally speaking, like this is an example of why we talk about what we talk about. Is it a shock? And I know I talked about this in the very intro of this video from tonight, but is anybody like shocked that the market move was so aggressive to the downside under the premise that breadth was already horrific? I mean, nobody should look at the market move today and say like, wow, I can't believe the market moved down so aggressively. We've been yelling from the rooftops, hey, breadth is bad, breadth is bad. It's been the intro of every single weekend update and midweek video for like the last 3 or 4 videos, which is 2 weeks, right? So nobody should be surprised about that. Breadth continues to get worse. We will start to use this, or I'll speak for myself. I'll start to use this as a contrarian indicator here on the 50 SMA moving average. That's the blue thing down here. As that starts to get down towards, I'll show you on this chart here. As that starts to get extended, look at that. We haven't been over to this chart in so long that the gray bar is not extended. Let's bring this to the end of the year here. Let's go out to Feb. There we go. As we start getting into sub 20%, this means that less than 20% of stocks in the S&P 500 are trading at or above their daily 50 SMA. That starts to look pretty darn extended to the downside. Now, I'm not going to say it can persist there. Take a look at what happened in 2022. Right? You get a little bit of a counter trend and then it gets back lower. You get a little bit of a counter trend and it does it again, right? So just generally speaking, as we start approaching this, keep in mind that you don't want to be short dead on the lows of the move when you're getting into oversold territory like this. So I think this supports the idea of what we were talking about on the S&P analysis, where, hey, probably makes sense to not be an aggressive short into the end of the week unless there's some interaction with the gap and you can cleanly manage your risk. Let's move along to the RSP. This has been part of the breadth story for the last week as well. Just how many days was it? I think it was 12 days at the final count. Huge move to the downside and getting worse on today's breakdown. So once again, that was telegraphing the opportunity, at least, for a stronger liquidation break. As we look at the QQQE, it's the same exact thing we talked about down here, how the NDX was over its pivot and this was already at the pivot. Remember, we were trading at a new all-time high, while this was just bubbling around at the pivot. So again, not a shock here out of the NASDAQ. The Dow has been saying the same story. Big crush here, big crush here. Same thing, same old song and dance. Breadth was horrific, headed into the FOMC. Volatility, as we mentioned in the intro, is starting to get spicy like it was back in August during the yen carry trade explosion, if you will. So I'm going to continue to monitor this. If VIX promptly gets back down underneath 2050, that's where I think you probably say, all right, that's it, flash in the pan. Fed ignited the market, but we're not really going to see continuation to the downside. If this promptly reverses, I think we're in the clear. If you look at the VVIX, it really didn't get as bad as I thought it might have. You got some breach of this area in here at 120, but you did not see an acceleration up towards these like nutty levels. And remember that this is the yen carry trade. Generally speaking, we just saw similar volatility out of the market. This is the yen carry trade blowing up back here. That's the August 5th gap down. I mean, this is one fell swoop, and it's a domestic instead of international catalyst. But, I mean, I would not call this the same under the hood level of volatility compared to what we saw actually out of the August 5th yen panic. If we take a look at the volatility futures, and you're going to get a special little treat here in a second because I've got another trick up my sleeve for you. If you look at volatility futures, was FYI expired today, so roll these out if you use the distribution here. These are in or at least they threatened a backwardation, but they're already back in a contango. Trying to get over the zero mark. Obviously, this is abysmal. Obviously, this goes from the lowest reads we've seen in a long time up to some of the highest reads. This is much closer to the yen carry trade days. But one of the things I might want to suggest or at least explore as an idea is let's go on over to the VIX. Let's hit the trade tab and let's take a look over here. What do you notice about the option statistics happening over here? Look at the calls on the VIX traded at the ask or above, right? Versus at the bid or below. This is somebody waiting and working the bid saying, hey, I want to get filled at my price. This is somebody saying, get me in right now. I don't care what I pay, right? Obviously, many more calls on the VIX went through at the ask. What would that imply? You almost had you wouldn't call it a gamma squeeze out of the VIX relative to the S&P 500, but everybody buying VIX calls basically is a signal to the market to say, yeah, let's unload, let's unwind S&P deltas, moving in the downward direction. So could this be an inverted gamma squeeze based on VIX options there? And if you take a look at the SPY, right, take a look at the SPY options down below as well. Look at puts in this case, and you want at the ask or above. I mean, you traded not quite twice as many, but you have 41% of the volume going through there. On the put side, that again is more of a signal to me that everybody's getting greedy intraday and saying like, hey, buy puts, buy puts, buy puts, buy at the at market or above. I mean, that's totally like greed to the downside. That's totally the metrics, or what would you say, mechanics of spiraling the market out of control lower, right? So yes, there's a number of things that we've covered today that would suggest, mainly the market internals, if we just go back over to this screen, that would suggest strong shift in the technical foundation of what's going on in the market. We also have the fundamental shift based on Jerome Powell, but the market mechanic was no help today. So could this be overblown based on that mechanic? Could you see a counter trend move? Yes. And then could you look for a lower high? That to me seems like the most reasonable outcome based on this exploration that we've just conducted. All right, let's jump on into the core list of companies. Let's keep it brief on today's session. We've been talking about NVIDIA until we're blue in the face. A couple of posts over on X as live videos there. This breakdown back underneath 132.25 aligns with what we talked about in the pre-market prep. This is a breakdown of the head and shoulders, left head, right shoulder. We're underneath the neckline, and today, of all days, it was the day where the buyers, if they were going to keep this gap up in force, if they were going to keep this as a failed breakdown of the head and shoulders, they needed to hold 132.25. Did it happen from the Fed? No. We're lower. We are absolutely lower here. Counter trend in the post market is taking place, but we know that MU is putting the pressure on. So I personally think that as long as NVIDIA is underneath 132.25, it's got more downside in it, right? And that's been my level for a number of days now. We've been talking about it on X. We've been talking about it here on YouTube, continuing to use 132.25. Underneath, I think this has bearish legs to the downside, and Santa does not come to town for the S&P 500. All right? Hate to be the bearer of bad news. Here's Microsoft. What's going on in Microsoft? And this is where we start to think more so about daily trends, please, right, relative to the NASDAQ. This is a big old retest of the top end of the balance range. Really, Microsoft is pulling back from the highest high in the trend count. We had lows. This was a balance. We broke out. We extended. We had a wall-to-wall move from the bottom of the balance to the top of the balance. No pullbacks, right? And we went through the top end of the balance. Is it reasonable that we could set a higher low here, daily or weekly? Absolutely. Absolutely. So Microsoft, really interested to see if we can get some response off of 438. If we can, and we can stay over that, I think this builds out some sort of higher low structure, and we want to be long here. Risk reward like this. If we fall through 438 more aggressively, you get one final chance here, but at that point, you have too much of a risk of this, right? Lower high underneath the top end of the balance from back here. So 438 do or die on Microsoft. Apple, at fil, as we've been saying in the pre-market prep. Highest high, all-time high, pulling back. Anything detrimental out of Apple? The old guard, the oldest guard of tech, basically. No, absolutely not. I mean, think about what happened here. You hardly saw a bearish engulfer. You made a new lower low on the bar-to-bar count, an equal low to the Monday session low. You're still over this congestion. I think Apple has got plenty of room for either consolidation to continue here, builds out a head and shoulders on like the hourly, break the neckline, pull back to here, send a higher low, risk reward is this. Right? I would love that. Show me that on Apple, and I'm participating into the new year. All right? Consolidation that persists up here, call it for what it is. Bull flag until proven otherwise. 253.75 is your level. Next up, Nancy, what's going on here? Really want to see the retest of this zone. We have overhead supply, finally. Let's see if we can get a breakdown more aggressively underneath the bottom of the new balance, not sponsored range. That's 225.25, any lower highs that are set below. Really interested in a move to 214. If we can go for a gap fill reversal, so say it looks like this, and then we get one of these, I want to be long here at 214. I want to be looking at previous resistance acting as newfound support. Daily chart is what drives the thesis, right? Brand new all-time highs. Show me the pullback. Give me the offering over here. Daily trend, weekly trend remains up. That's what we're looking for. Any big issues with this? No. Let's move on over to Google. Didn't mean to skip you. I'm sort of bummed that this actually happened during Jerome Powell's press conference. I would have loved to see this lower high. You guys know I've been tweeting about this. I've been talking about it in the pre-market prep. I've had this sick obsession with like the Willow thing being a farce, and then ultimately, showing the breakdown here, thin structure retracement, get us back down to 180.95. My apologies, 181. So a little sad that the breakdown happened during like peak volatility from JPOW. Ideally, this just sets a lower high, gives me an offering of this opportunity to do this, and balloon runners to look like that. I'll have to change my tone if there's a higher low here, and only if there's a higher low here, I would then trade back to the bull side if we're over 195. That's Google. Metaverse. Meta is very similar to Amazon in the sense, even Microsoft actually, in the sense that we have this previous range. Of course, we broke down aggressively today. If we could support over the top end of the range at 599, I mean, come on, folks. This is like, trend analysis 101. Resistance, 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 resistance. Break to a brand new higher high in the trend count. Higher low can be found here at 599. Do I want to just like stick my neck out on the line and say like I want to be long here after this massive breakdown? Responsibly, yes, I do. I think the risk reward profile favors the long here instead of the short. Great opportunity off of 599 if it can hold. So we shall see. We shall see out of Meta. Let's take a look at the Teslaverse. Let's see what's going on over here. Obviously, Tesla coming in, very similar to everything else. I would say that this is almost unfortunate. There was, in theory, going to be this big poetic, big bang up over $500 on a gap up or something of the sorts. And the big move lower today sort of put the lid on that idea. And now I don't even think there's a big parabolic short. I think that this goes sideways. I think it consolidates out over the previous all-time high. And just as a reminder to be responsible here, let's go out to the price axis. Let's throw it on a log scale. And let's jump this up to a max available monthly chart. Let's go to max available. And just as your general reminder, this typically, the party's just getting started over the top of your previous highs, right? So am I saying you need to long this right here, right now? Look for the responsible entry, but generally speaking, Tesla has a history of long-standing compression for a couple of years, things get nutty. Couple of years, let's see if things want to get nutty. That's the long-term idea. Into the end of the week, are we focusing on a long into the end of the week? Probably not, right? Probably being a little bit more responsible back on this daily. We want to take this off of the log chart. Let's do that. There we go. Probably thinking about just consolidation. If we can hold 415, I think that's where buyers might start to step back in, and we'll see if we can get a rotation. If we just get consolidation, we'll let it be, and we'll wait for some sort of consolidation on the daily to lead to that next move to the upside for the monthly, right? That's that. JP Morgan, we talked about XLF, no issues on this, breaking down into the gap, obviously looking for it to continue to close. Previous all-time high 226, full gap closed 222. This is the election gap up, and just keep in mind the idea, the thesis of rates not being favorable for the deregulated environment where everybody's like, oh my God, deals are going to go off the chain. It's going to be crazy. Well, one component of that is now missing. You're underneath your daily 50 SMA. I would watch very closely for the 226 and 222 levels here out of JP Morgan. If we could hold over it, I think that's where things start to get interesting. Believe it or not, earnings season is right around the corner again, so be patient on that. Let's take a look at Netflix, and then we'll finish on MU, a deeper dive over there because of earnings, and that's it. No special trade ideas today. Netflix breaking down from the overhead supply. This is not one of the long ideas where I would say, hey, let's cherry pick this low. No, we're underneath what was acting as resistance, support. You're underneath that now, so much more neutral through here. I think the next short sets up underneath 868. On a lower high here, you might want to get involved like this on some sort of breach and Brigade bolt here. You have thin structure, right? That starts to get interesting for risk reward profiles like this. For the long, it would have to be a Brigade bolt back over the previous all-time high resistance here at 907.25, in which case the true all-time high is going to be your Brigade bolt to blue sky territories, right? This is always early in the earnings announcement cycle, so keep that in mind as well. The next couple of weeks are going to go by like a flash as we head through the holiday season. MU, and then we're on our way. What do we see out of MU? The big gap down brings us to 86.86. 86.86. Where is that on the chart? Let's take a look. 86.86. Where are you? You're down here, actually, closer to the bottom end of its long-standing balance. So this might actually be, believe it or not, you heard it here first on the channel, believe it or not, you might get an interesting oversold long opportunity for this. Again, I'm not saying it has to hit the top end of the range, but if you're thinking about where you're positioned, where is the risk reward, I mean, this is like key support that you're gapping down into. You just had awful news from the Fed. If this is an overblown reaction, I mean, this could easily catch some sort of bid off of 86.50. Find, even if it's just a counter trend move, your job intraday is to look for a 5-minute setup or whatever as a scalper, just to capture some of this move, maybe into this previous gap close from earnings here. That's 92.65 to 90.95. And that's what I'll leave you with for today's session as an idea, just the final bottom end of the range here out of MU. With that, I think the final thing I'll leave you with is actually taking a quick peek at the USDJPY. just to see if anything's going on over in the yen. We know that there was the Bank of Japan meeting that I believe it should be at 8 o'clock is when their meeting is, right? Or sorry, it's 7 o'clock our time. It's 8:50 theirs. And then at the 2 o'clock time frame, I believe that gets closer to our midnight. I'm probably doing the math wrong there, but nothing so far, right? You'd really be concerned if this started to move down aggressively, right? If it moved down aggressively, means that the US dollar is losing big time relative to the yen, or you could say in the opposite sense, right? The yen is strengthening against the US dollar. So we're not getting that. We're currently just holding in there fine and not really seeing an outright move. If you take a look at the /6J as another expression of the currency, this is the yen futures. What you would want to avoid, of course, is like what we had in August, where you get this big run. I don't think that this chart is properly adjusted for contract change. There we go. I was like, that doesn't quite add up. There we go. These are much more equal highs. You're not really getting this big rally, right? The yen is not strengthening in a material way that would unwind the yen carry trade right now based on a decision from the BOJ. So if you hear some big headlines about that, just call the market's bluff. Call whoever wrote the headlines bluff, because the 6J is not particularly moving. And the final check would just be the Nikkei 225, JP, there it is. Taking a look over here, obviously this is not currently open, but based on today's session, small gap down, but still inside of this range here. As long as it's over the bottom end, I would not be overly concerned. Think about what the August 5th panic looked like across markets. You're just not getting that. You're not getting this global unwind of what was happening with the yen carry. All right, those are my final thoughts for today's episode. If you enjoyed it or learned anything new, if you like the new little introduction format there for the story time with the Trade Brigade in terms of what happened on today's session, drop me a comment down below or give the video a very simple thumbs up. I appreciate you all coming out to the show. We will be hanging out in the penthouse tomorrow morning at 8 o'clock Eastern time for the pre-market prep. I hope to see you there. If I don't, I will see you in the next one. Have a green trading week and enjoy the holiday season.